Hello, my name's Zane and welcome to another episode of ZEP Learning. Today we're going to be discussing Guarantor Loans. I do have a lot of clients who have been using guarantors recently, and I guess this is just to give you a bit more information about how that works. First of all, a few benefits of using a guarantor. So a guarantor helps you get into a property sooner. It means that you don't really need a deposit, but it's always great to have some of your own funds and prove that you can save. It means that we're avoiding mortgage insurance, so that's a saving for the borrower or the children. I guess some of the other benefits are that it's easier to get the loan approved because there's actually just the lender looking at it. It's not the lender and the mortgage insurer looking at it. And we're getting the best access to the best rates on the market. All the rates are tiered at the moment. So we're actually getting access to the rates for borrowing below 80% of the house value. Who can be a guarantor? So a guarantor is generally a direct family member, so brother, sister, parents, grandparents. In the odd exception, there is some other people, and we can discuss that. How does a guarantee work? So it's very different to what you used to think, I guess, from the olden days. A guarantee now is just using a portion of your security to help guarantee or secure the loan. In the past, it used to be a servicing guarantee, which meant that you were guaranteeing their repayments as well. Now, really, all you're doing is using a bit of the equity in your home to help them get into the loan sooner and to avoid those fees that we just discussed. How much is the guarantee? So the guarantee is actually everything above 80% of the purchaser's property value. So 80% of their property that they're buying is secured against their house, and then anything above that, so up to 105% of the full house value. The 5% is for the costs, the stamp duty, the legal fees. So really the guarantee is about 25% minus whatever deposit the purchaser already has. It is quite, there is a lot of ways to get out of this. What happens if the guarantor wants to sell their house? In that case, we can actually secure the guarantee amount against a term deposit until you've actually found another house, and then we can transfer it across. What happens if the borrower actually is defaulting on the loan or in trouble? So the majority of lenders by law have got to have a solution for when a borrower is in distress or in trouble, so if they lost their house. So as long as they're keeping us informed, there's always an option that we can get to or we can figure out, so then there's nothing happening on the loan. There is a whole heap more I can discuss here, but I don't want to go into too much more detail. There is a great fact sheet on our website, so if you'd like to have a look at www.zepfinance.com.au and the little Learn tab at the top, that's where you'll find all these videos and those fact sheets to download. Thanks for watching, and I'll talk to you again shortly.